Hello, hi. So today I have come up with a video and I don't have PPT today because mm, as you have requested to make a very simpler video on what is derivative. Today I'll be explaining derivative using the website of National Stock Exchange. And first you need to open the website. So when you click on to the live market, you can see you'll get various informations. Um, so you can go to the index out here or you can directly type any company's name out here. So I have selected Sun Pharma to explain what actually is a derivative market, or options. What is options? So this is a very simpler video, and just for a revision, it will be easier for you to grasp the idea about what is derivative market. So when I'm explaining about the trading in commodity or forex, so it will make sense to you. It's very simple. You can see the value of Sun Pharma right now is 470, and this is the data of the last trade as on May 8. So you can see the price was 470, and in one day it had made a gain of 3.94%, which is a quite good amount in one day. So as we all know that in corona, due to COVID-19, pharmaceutical companies are doing much better. So if we have some analysis and we think that any company is going to increase, but the main constant can be the capital, because if we want to buy 1000 shares of Sun Pharma, we have to pay 470 into 1000, 4,70,000 plus other charges like brokerage charges and various other charges, which the average price may increase, and we need more than 4,70,000 also. So if you want to speculate the market for a short period of time, we can uh, you know play into the derivative market. So we can get various derivative codes out here, or we can see the option chain also. And the importance of this derivative market is that we do not have to pay 470. If we play in the derivative market, we do not have to pay 470. We need to pay a small amount which is known as a premium, and premium varies according to the strike prices. So you might be thinking, what is premium, what is stock prices, what is it actually? So I'll be explaining after a few minutes what is it. But to make your concepts much more simpler, there are many dimensions, but I'm explaining from the trading perspective, not the hedging perspective or any other perspective. I'm explaining from the trading perspective. So we want to buy the shares of Sun Pharma, but the price is 470. So we know the you know just an assumption, we know that the Sun Pharma share is going to increase if we have a proper analysis, or it might happen that sometimes our analysis tells that the price of Sun Pharma or any company is going to decrease. So but we need to have a money, that is quite 470 into 1000 is 470. Or if even if you want to buy if we have 5000, we can buy around only 10 shares, because 470 into 10 is equal to 4000 plus charges. So um, you know but if we have 5000, we can buy much more number, higher number of shares in the derivative market, which will eventually increase the profit also. But there is other side also. If our analysis is not good or efficient, we'll be losing huge amount of, we'll be making huge loss also. So let us see the option chain, and keep it in mind the current price is 470. So let us move on to this option chain. So when we just click onto the option chain page, this page will pop out, and as I told you, This is, the spot price 470 Sun Pharma. This is the spot price. Spot price means the last close price or the market price. So this is known as spot price Sun Pharma 470 as on May 8. So today market still not yet open. It's just 8:40. So after a few minutes market is going to open. And whenever we are playing in the derivative market, especially in the option, we need to understand the importance of this strike price. As you can see, there are various strike price, but first you need to understand what is strike price. So normally when we play in option market, we need to take care of two prices. This is the real price, this is the market price 470. And there is an assumption. Some people might think that Sun Pharma share price will decrease from 470. Some will think that the price is going to increase from 470. So different people have different perspectives. So as you can see, this strike price means this is a kind of forecast of different players in the market. Some are forecasting the price, it can go up to 230 or 300. I mean, the different price ranges. So this is, in short, the strike price is the future price which the traders are assuming the spot price to increase or decrease. And but when we are playing in the derivative market, especially in the option market, we need to first take care of the spot price. What we need to see, what is the spot price, and then we need to select the strike price. So what is our assumption? So say we are thinking from our analysis that this 470 is going to it might go up to 500. You can see it might go up to 500. But we cannot just say that this 470 will reach 500 next year. It won't happen because there is an expiry date. The other third thing which we need to take care of is this expiry date. So there are normally three contract periods, like which is near and which is far. So if you can see 1 month contract, 2 months contract, and 3 months contract are there. So it can be 28th May, it can be 25th June. So 28th May is the last Thursday of May, and 25th June is also the last Thursday of the June. So now you have understood that the expiry will always happen on the last Thursday of every month. So let us select 28th May. So this means we are right now, the price of Sun Pharma is 470. We are thinking that this 470 is going to increase till 500, and the time period is within 28th May 2020. So we have much more days left. So we can select this contract, like 470 is the spot price, and within 28th May 2020 this 470 will increase to 500. So in the cash segment, we had to pay 470. We had to pay 470, and if it increased to 500, the profit would have been around 30 rupees. But as I told you, if we had 5000 rupees, we could have bought only 10 shares. So 10 into 30 is 300 rupees only, and after deducting charges it will be still much more lesser. So the importance of derivative market is, you can see the spot price is 470, and we think that it will go up to 500. We need to pay small amount, we don't need to pay 470. So if we think that the price is going to increase, we need to select this option which is known as call option. So there are two options, one is call option, another is put option. So again, I'll revise it for you. We need to first see the spot rate, which is 470, and the expiry date, which is 28 May. We have selected the near term contract, and the strike price we have chosen is 500. So we need to pay a very minimum amount, and for that we need to see LTP, which is last trading price, which is also an option premium. We need to pay we need to check LTP. So when we check LTP, and among this 500 range, we can see it is 14.30. So we just need to pay 14.30. So I'm just telling it, even if 470 is going to 500, and we'll be making profit in the cash segment, but we need huge capital. But in the derivative market, we just need to pay a minimum amount of say 14.30, which is quite lesser. So after we pay 14.30, we can buy call option, and if the price increases from 470, so there is a chance that we might make a profit. But there are other concepts of calculation of break even point also, so that today I won't be explaining. Today I'm just making a simpler video in the options. So I hope you have understood it. And there are various other informations also which we need to take care of, like open interest, change in open interest, volume or IV, relating to volatility, and bid quantity, bid price. We can use all these informations. So and there are two contracts. One is call option, another is put option. If we think that the price is going to decrease, similarly we can select the put option also. So I'm again repeating it to you. Whenever we are playing in the derivative market, we need to see the spot price. In this case it is 470, and then we need to see the expiry date, which is 28 May in this case. And after that we need to see the strike price. So out from strike price, this is a future price. Suppose say for example we are thinking that the price of Sun Pharma is going to decrease, then we can select a price which is much more lesser. Say we are thinking it to go to around 450, so we need to select 450, which is the strike price. But now we'll not select the call option, we'll select the put option. And likewise there's an LTP you can see, which is the last trading price. So if we select say 450, we need to pay the LTP of 16.50. So in real cash segment, we have to pay, we can do short selling at the range of 500 450. But in derivative we can just buy a put option, and we need to pay a minimum amount of just 13 point no sorry 16.50. So derivative market out here is quite simpler. But I'm telling you, we cannot buy from here. If we need to trade, we need to have a demat account. This is just an exchange website from where we can get the real information, live information. And so I hope you have understood it. And in the next coming video I'll come up with more other videos also. But there are derivative market for equity also, and there is a currency derivative also. So right now I have chose equity derivative. If you want to see currency derivative, you can check currency derivative also. So it is same only. So there are various options like USD, JPY, or which is a Japanese yen, or European, or USD, or GB. I mean, you can see there are various uh, you know um, currencies pairs. I've already explained what is currency pair. So if I have selected USD INO right now, and this is the data for 8 May, and as I've told you that this reference rate is given in the RBI. So the reference rate is 75.44. So this reference rate is taken by the RBI. I've showed you in the previous video where to get this data from. And similarly, out here also you need to select the strike price. So if you think that the you know USD INR currency pair value is going to decrease from 75, it is going to 74 or 73, then you need to select from the strike price. So out here, suppose I'm selecting say 70 um 74. So I don't have to pay this 75.44. I just need to pay you can see, as I've told you, what is the LTP out here. 70 for LTP is 0.0025 only. Likewise, if we are thinking that this USD INR currency pair, this reference rate 75 is going to increase, we need to select this call option and we need to check this LTP. But I'll explain you one thing, that is when we are in the derivative market, we cannot buy one stock or two stock because there is concept of lot. So going back to the currency derivative, um okay, let us check one of the, in order to see other companies data, you can go to index, and I'm just selecting Nifty 50. So from Nifty 50, I'm just again selecting Sun Pharma. Going back to Sun Pharma, this is equity derivative again. So there's a concept of lot. So we need to see what is the lot of Sun Pharma. You can, for that you can go to get derivative quote, and let's see. Okay, so minimum market lot is 1250. So you can see market lot out here. So minimum market lot is 1250. And let us see you can just select stock derivative out here, Sun Pharma. There's an option, you can select stock future or you can select stock option also, and there's an expiry date 28 May call option. You can choose either call or put. As I've told you, if you are thinking that the company share price is going to increase, you can select call option. If you're thinking this company share price is going to decrease, you can select put option. So we are thinking that Sun Pharma, we're assuming that Sun Pharma might increase, so choosing all option. And so in the last example, we were thinking that the price might reach 500. So you can click on get data, so you'll get the data. So there was a increase of around 17.21%. Yeah. So that LTP had opened for 13 and made a high of 15.20, and closed around 14.20. On one day, the net return was 17.10. I hope you remember in the beginning of this slide, I was explaining that if you are playing in the cash segment, the return would have been 3%. If you don't remember, you can just go back and check on this video. But if we play in the derivative market, the same gain would have been around 17.21%. So this is the importance of derivative market, that even if the analysis is proper, with less amount of money can make a good amount of money. Say in one day earning 17.21% is a good return. But yeah, understanding derivative market is one of the, I can say, the last play after understanding all the market and various trades. So one can move into the derivative market, but knowledge is very much important. So today I've explained what is a spot trade, what is strike rate, what is LTP or the option premium, and what is concept of expiry date, and even the market lot. So I've showed you the differences also. When we play in the cash segment, we need more capital. If we really buy Sun Pharma, we need to pay 470, and if we are thinking that that 470 is going to become 500, we need to pay 470. But the same thing if we do in the derivative market, we just need to pay, I had showed you that some around 14.30, or in this case the previous open was around 13 rupees. So by paying 13, and it increased to 14.30, it is 17.210%. So but there are many things which we need to understand before jumping into the derivative market. There is various sorts of analysis and sophisticated analysis. One need to have experiences also, and self analysis is also very much important. But these are the basic things which I wanted to understand, I mean explain. So you can go to commodity derivative also, the concept is same. And you can see most active contracts, and even the expiry you can see. So you can go to the, so anyway, relating to commodity derivative, I'll be explaining in the coming video. So today I will, because time also is a constraint, so I won't take much time. So again, I'm repeating it. You can go to live market, and you can select equity derivative or currency derivative, and you can select commodity derivative also, currency derivative also, equity derivative also. And if you want to find a company, one option is you can type it out here, or you can, it much easier will be, you can directly go to index. When you go to index, you'll find top 50 stock, which is nifty 50 out here, or top 100 companies, which is nifty next 50, or nifty 100 companies. Or if you want to see sector wise, you can see nifty bank. If you want to see a banking stock, you can go to nifty bank, and you'll find various banks out here. So Kotak Mahindra, HDFC. And if you want to see the derivative, you can directly see HDFC bank, directly click onto HDFC bank. So this page will pop out, and you'll see the spot price out here is 930. And if you want to see the various stock prices, sorry, strike prices, or option premium LTP, you can go to option chain. And after you go to option chain, as I've told you, the HDFC bank spot price is 930. If you are thinking that HDFC bank share price is going to increase, and you need to check the expiry date. So out here, three expiry dates are here. So 28 May, 25 June, or 30 July. So 1 month, which is 28 May, is 1 month, which is near. uh, 25th June is next month, and 30 July is another third month. So we are selecting the near month expiry contract. So as I've told you, spot price is important, expiry date is important, because if we choose this expiry date within 28 May, this 930 should reach the price, should reach the strike price theoretically, say 960. Right now the price is 930, should reach 960 within 28 May. If it will not hit the price, then there's a high probability of making the losses. So like in the cash segment, we don't have to pay 930. As I've told you, we need to see the LTP, which is the option premium price, which is very much minimum. So if we are thinking the price will go to 960, we just need to pay, if we see, 26 rupees, 26.55 rupees only. And plus charges, we need to pay certain charges also, which I'll not be discussing in this video. But I'm again telling you, we need to know the lot size also. So if you want to know the lot size, what you can do is okay, you can go back, and we had gone to option chain. Right now you can go to get derivative code. After going to get derivative code, you'll come to know what is the lot size. So out here the lot size is 500. And you can make select out here also. You can select future. If you want to play in future, you can select stock options. and expiry date is 28 May. There are other expiry date also I've explained. And if you think share price will increase, you choose call. If you think it will decrease, you choose put. So since we are thinking it will increase, we are selecting call option. And you can select strike price out here. So we are thinking from 500 it will go on. Sorry, what was the spot price out here? Okay, spot price was something 920. Okay, so let us select 960. We can select 960. You can select get data. So this is how, since there's no information out here. So I hope you have understood it. Any doubts still you have, you can feel free to write, because derivative market is also a huge concept. Today I just explained to you the concept of the spot, what is spot price, and what is stock price, strike price, and some premium, and what is the expiry contract period and lot size. But again, I'm repeating it, we cannot buy derivative market from NSE exchange. We need to have a demat account, any demat account. So in order to do the analysis, we can do analysis, see the data from NSE exchange, and we need to do proper analysis before entering the derivative market. This is just one ABC of the derivative market. There are so many things which we need to understand. So I hope you understood the basic concept of derivative market and how to see the data. So stay safe, and see you soon. Still you need more explanations, you write in the comment box so I can come up with a more simpler video. Thank you. Till the time, take care.